Good morning, ladies and gentlemen, and welcome to the PACEDIGITK Q3 FY26 earnings conference call, hosted by Goenka Advisors LLP. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Khushbu Shingaria from Goenka Advisors LLP. Thank you, and over to you, Ms. Khushbu.
Thank you, Swapnali. Good morning, everyone, and welcome to PACEDIGITK Q3 FY26 earnings call to discuss Q3 and 9M FY26 results. We have the senior management of the company on call, Mr. Venugopal Rao Medisetti, Chairman and MD, Mr. Rajchandran P, CFO, and Mr. Ajay Tamre, Head IR. We would remind you that the discussion on today's call may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. May I now request Mr. Venugopal Rao to take us through the company's business outlook and financial highlights, subsequent to which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you. Good morning, everyone. I am Venugopal, the Chairman and Managing Director of Digitek Limited. We have just announced the Q3 results. We have about 644 crores revenue, which is about 13.5% higher than the previous year. And then on the PAT, also we have closed at about 79 crores PAT margin, which is at about 12.2% higher. And in the last quarter, we have some good orders, both in the telecom as well as in the energy sector. Today, as we stand, we have about 6,000 plus orders from the 6,000 crores from orders have been awarded to us, and some more on the pipeline, where we have been declared L1, but awarding is in the process. That is also a good number. And the telecom, we are at about 2,400 crores. We have the order book. And another aspect in the last quarter, what we have done is that we have delivered about 400 megawatt hour of BESS, which is a remarkable thing in any fact. We are the first in the country to deliver so much capacity in the last 3 months on the BESS system, and out of which already commissioned 200 megawatt hour of BESS systems in the field, and they are working satisfactorily. And we have the order book on the BESS, as I mentioned, 6,000 plus crores, and we wish to touch up by 10,000 crores by March. As I mentioned, we have been awarded is 6,000, but in the pipeline where we have been declared as about 4,000 plus is there, so which we will be announcing in the near future. So in March we would have a healthy order book on the BESS, and also on the telecom we have a good order book. Orders have been closed, and then we also are expecting some more orders in the near future. And on the manufacturing facility for the BESS, we will be 5 gigawatt hour by March. All the equipments have been shipped from our manufacturers, and they are expected by first week of March, and they will be commissioned by end of March or maybe latest by 10th of April. We want that facility to be fully ready for 5 gigawatt hour. What it means is that next financial year we will be manufacturing 5 gigawatt hour of BESS systems from our own factory, and also we are constructing a new facility where this 5 gigawatt hour we want to expand it to 10 gigawatt hour, which would take about another 6 months. By September is the target for us to make this facility ready. So by then we should be touching about 10 gigawatt hour of BESS system. That will be the first in the country. Also, we will be maintaining our lead. As of now, we are the leaders in this BESS manufacturing, so we would like to continue maintaining the lead from others. And further to that, we are also doing further backward integration, that the manufacturing of the BESS containers, because this is all these containers are quite big in number as well as the value. And the ecosystem is not readily available in India, so we have decided to manufacture them in our own factory. That facility also will be ready by mid of April, so that we will have good control over the raw material input supply for the BESS, as well as the cost control will be able to do better. So keeping these two elements in mind, we have started this, the fabrication is also getting ready. So these are some 3-4 highlights of the last quarter, and we do have it. We will be, the Q4 also looks decent for us. We will be closing near to our estimate what we have provided. And FY27 also looks strong because the order book is there. All this will be reflected on the balance sheet. And next financial year, we would like to see the BESS business contributing decent on the balance sheet. So these are some 4-5 highlights from my side. And I would like to ask my CFO to go a little more deeper into the financial numbers, and then we will take the Q&A session. Thank you very much.
Yeah. Good morning, everyone. This is Rajavendran, CFO of PACEDIGITK. On behalf of PACE family, we welcome all the investors for this call. Now I will take you through the financial performance of Q3 and the 9 months ended December 25. Starting with the top line, our consolidated revenue from operations stands at 644 crores, which is representing 2.7% quarter-on-quarter growth, and which is 13.5% year-on-year growth. This growth is driven majorly by the improved project execution across both telecom and energy sectors, supported by the better project momentum, which is during the quarter. For the 9 months ended, the revenue stood at 1,544 crores, and there's a compared to the previous year because of the timing differences that we had. Moving to the gross profit, Q3 gross profit stood at about 169 crores, which is a gross margin of 26.3% compared to 32% in the same quarter of the last financial year. This impact is mainly due to the project mix. Coming to the employee expenses, the year-on-year, we had increased the employee expenses for about 25 crores, which reflects a capacity building across the energy sector for all the projects that we have commissioned. And these costs are forward-looking and aligned with the expanding order book. Then talking about the finance, EBITDA numbers, EBITDA number was about 117 crores for Q3. Which is a margin of 18.3% compared to 21% of the last financial year. This EBITDA movement, again, as I specified in the gross profit, it is majorly due to the mix of the project and the execution phase, including the milestones that we have achieved. Coming to the finance costs are considerably down compared to the last financial year, considering the reason that we have a lower borrowing levels for the quarter and also for the complete year. The other income stood at 10.2 crores, which is on the higher side compared to the previous year, which is specifically to the reason that we have this IPO funds and all these are put into the fixed deposit, which has given us some steady growth. The profit after tax stood at 78 crores, representing a 11.3% year-on-year growth with a PAT margin of 12.2%. On the balance sheet perspective, we are at a comfortable position with a leveraged balance sheet, which will be supporting growing energy business as well. The working capital is again managed with a continuous focus on the milestone-based billing for the project. And during the quarter specifically, we have taken an impact on the paid-up share capital considering our listing in October 25. And as an update, we have also incorporated the company Digitek Energy Private Limited, which is a wholly owned subsidiary of PACEDIGITK. This would be a platform company which would be managing all the SPVs on a build-to-own operate model. We have incorporated this company as a wholesale company for the SPVs to have a separate focus on the asset-owned businesses and to focus more on EPC and manufacturing at the parent and the other subsidiary company as well. This structure allows us to raise the project funding at the SPV at the wholesale level and also to ensure that the assets are managed effectively. So more specific to the build-to-own-operate model of business, for this financial year or for this quarter more specifically, the asset creation stood at about 167 crores, which is out of the order book of 3,250 crores of build-to-own-operate model. So we have started executing the MSEDCL project in particular, and we have booked this 167 crores for this project as asset in the consolidated balance sheet. And on forward-looking statement, as our MD was explaining, we are keeping the FY26 numbers intact, whatever we have estimated, including FY27 number 2. So the strong order book, what we have in both the energy and the telecom sector, will take care of the estimates that we have taken for FY27. So with the robust order book and the improved execution momentum and the disciplined capital allocation, we believe that the company is well positioned to deliver the sustainable growth with financial prudence. So with this, I end my speech here and open to the floor for the questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants, you are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Anuj Patil from Taurus Mutual Fund. Please go ahead.
Good morning, sir, and congratulations for good set of numbers. Thank you. So my question is that are hyperscalers or colo players engaging directly to you, or it is the demand is rooted to EPC level or from utilities level?
Sir, so the demand is rooted in terms of the EPC project majorly. The EPC projects at both telecom and also the energy sector.
Okay. And sir, you have mentioned that you are expanding to 10 gigawatts. And what is the utilization threshold is needed for reaching optimal ROCE? And also let me know that if there are any execution bottlenecks in achieving that kind of expectation.
Yeah. So this 10 gigawatt hour, what we have planned, sir, we already have about for the next year. That means after we close this March production, the open order, the order that goes carry forward to the next financial year, that is April, is about 6 gigawatt hour is already there, as of today. So what we believe is that in the next few months rather, we would be able to bring in some more business because the demand is quite huge. So we will be utilizing the expansion facility when it happens by September. So our plan is that from October to March, we will be able to give 2.5 gigawatt hour in addition to this 5. So what is our target? Our target is 7.5 gigawatt hour, for the manufacturing for the next financial year. And out of that, we are quite confident to achieve the business because almost 80% of that is already achieved, as of now. Good thing is that these are the long-term projects of 12 to 18 months, projects. So we are planning for the expansion well in advance.
Okay. So
Thank you. We have the next question from the line of Paris Taylor from Purple One Vertex Ventures LLC. Please go ahead.
Yeah. Hello, good morning, sir, and congratulations for the strong set of results. I wanted to, sir, understand what is our current L1 order position and what percentage of that will get converted by March 26?
Sir, so as we stated, we have an order book of 6,000 crores in energy, plus 2,400 crores of 2,460 crores in telecom. What we are trying to estimate is that we are estimating this energy segment to go up. There are a couple of tenders which we have bidded where we are also L1 in a couple of tenders. So the results are expected, these projects are getting awarded soon, and we estimate that it will get awarded before March. So we expect this 6,000 crores to run up to 10,000 crores in the next 3 months down the line.
Okay. So basically for L1 you are expecting about 10,000 crores for the batch.
Yeah, we are estimating. Yes.
Okay. Understood. Sir, what proportion of this batch order book of this potentially 10,000 crores will be executed in FY 27 and 28 and beyond?
Sir, FY 27, as we estimated, we are estimating about 3,100 crores of top line. Means, say, this would be the revenue generation, but beyond this, the asset-owned models also will get executed. We estimate that this capex built-up asset creation for this build-to-own-operate model will touch about another 2,200 crores for the next financial year.
But that may not reflect on the balance sheet, but that will be sitting in the asset sheet.
Yes.
Okay. So out of the 10,000 crores, are we saying about 5,000 crores order will be executed for the best order book next year?
Yes.
Is that understanding correct, sir?
Slight change. The 3,200 crores will include the telecom segment as well.
Yeah. No. My question was, sir, out of this 10,000 crores potentially by March, let's say for best order book, what proportion will be executable in FY 27 and 28?
Around 40%. Around 40%. Both
Which
in the
is
EPC plus the asset-owned business put together, execution will be about 40% of it.
In FY 27?
Yes.
Yes.
Understood, sir. Fine. And sir, last very mind, how do margins in that EPC and, owner, BO projects compare with our telecom EPC margins, sir? And when do you expect our energy margins to, exceed telecom margins?
Sir, so the energy margins, it is bit different in our business model because of the reason that we have a backward integration. Like say, when I take a developer model of business, the EPC comes from the parent company and the product comes from the lineage power. When we take a EPC order from at the PACEDIGITK level, again it is backward integrated to our product from lineage power. So we have the margins at different levels. Like say the standard margins that we have is for the IRR of the build-to-own-operate model on a SPV basis stands at about 13 to 14%. The product margin is about 12 to 14%, and the EPC margin is about 8 to 10%. So these are the margins for the energy level. And telecom specifically, because of the nature of the project that we had in the past, which is a bit higher margin, and again there is a EPC project with the backward integration of our product, which has yielded us a good margins of about I would say 18% of the product margin plus 13 to 15% of the project margin. These telecom, these are project specific margins that we have achieved. The energy margins are slightly lower than the telecom, and it is expected to be at the range what I have stated. The telecom margins, it is a project specific as I stated, so it is a one time. And the energy margins are going to be there for stable across the years. And we have a positive update that we have a backward integration, means the competitors is separate for SPVs, competitors separate for products, and competitors separate for the projects. So as we are a company who is having integrated end-to-end operations for this segment. So that gives us a advantage in terms of the better margins compared to the other players.
Excellent. And sir, this last query, with the increase in the development projects in the energy order book, how much CapEx is expected over the next 2 years and how will it be funded?
Sir, the 3,250 crores of the order book that we have in build to an operate model is expected to be executed in the next 2 years in terms of the commissioning. So these 3 projects specifically have been funded, one by the IPO fund, where we have raised about 820 crores, net of the issue expenses of 70 crores. So 750 crores is huge for this 3 projects as an equity infusion. And moreover, the balance portion of say 75% would be funded with the financial institutions who will be giving a term loan for this project.
So that will be debt?
Yeah, that will be debt, yes.
Okay, so no further equity dilution is expected at least as of now?
No, at PACEDIGITK level, there will not be any equity dilution as of now for these projects. But we have good developer projects which is already funded.
Fine. Thank you, sir. I will come back.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. We have the next question from the line of Rohan Baranwal from Arihant Capital. Please go ahead.
Thank you for the opportunity. My question was on the side of tender prices. So in Q2, we had a commentary on aggressive bidding from the side of competitors. So have we seen any improvement or any returning to the tender prices? Are competitors still bidding at those aggressive levels, or have prices been stabilized?
Yeah. What you say is partly right, that yes, there was a very aggressive in the last 3 months, but whatever the orders that we have won, they are in a better situation, I would say, that out of 5 projects, we have won 3 projects. We have bid before this, the heavy competition started. That is one advantage we have. In the other 2 projects which we have won recently, there the advantage is that the different applications, not the same discom level BESS project. So we have chosen some different applications where the competition was not so much. Now, talking about this competition, it is obvious that in any new sector when the demand starts increasing, generally the people think that there is huge margins available in the business. People do bid, but I'm hoping that the correction will happen soon, because they are not able to execute on the ground, whoever has won. So basically, once they realize the difficulties involved in executing this new sectoral project, I'm hoping that they may not be bidding further. So prices would stabilize at least from April onwards is what is my mind. So that's what we are estimating. There were 4 projects where there was aggressively bid, but then people are now realizing those issues.
Got it. So follow-up is, do we see any benefit coming from the side of government imposing the duties on to localize the in-house manufacturing on the BESS sector?
Yeah. There are a couple of things from this budget. They have removed the capital equipment, the duties on the capital equipment that are required to be for manufacturing this BESS system. That is one advantage they have given. And in some tenders, the local content is being written properly. So that there should be a local content of minimum 20% and things like that. So we do believe that government should come forward with some more benefits, which we see that like the way it happened in solar. So similar lines, government is working, but we hope that it should come soon. That's what we are estimating.
Got it, sir. Well, my second question is on the side of capacity expansion. So as we are doubling our capacity from 5 gigawatt to 10 gigawatt, so with current order pipeline of close to 4.3 gigawatts, how confident are we to expand into 10 gigawatts, sir? And are we banking on exports as well, like markets like Saudi Arabia or Kenya or any other countries, sir?
Yeah, we are in hand. We have about 4 point something, yes. But as we mentioned, that in some tenders we are already declared as L1, which would be converted into orders soon, maybe in the next 2 months or so. That would take us to 6 gigawatt already. And then, the beginning of the year, capacity is 5, orders will be 6 gigawatts. So naturally, we are sitting on a good order position. And that is where we are looking at expanding this 5 to 10 by September of this year. So that the productivity will be about 2.5 gigawatts because it works only for half a year. So we are hoping that our production capacity for the next financial year will be 7.5 gigawatt effectively. And we are confident to utilize that capacity because order book is strong.
Got it, sir. Thank you very much for your answer.
Thank you.
Thank you. We have the next question from the line of Kapil from Branch Capital. Please go ahead.
Hi, thank you for the opportunity. My question is, with regards to this strengthening of the cell prices, are we seeing an impact on our BO projects in terms of the IRR, or have we locked up the cell prices way high? And what's happening with regards to the future orders? Are we doing a hedge immediately on the orders issued for the cell prices?
Yeah. So we have blocked these orders, where whenever we receive the orders, we normally book with this, our suppliers by paying some advances and other things. And this will not be impacting our project IRR. We have ensured that we are well within that. Thankfully for us, because we are the backward integrators, so that helps us to optimize the cost. And for the future projects, already the prices are increasing, so we are also bidding at higher level. Keeping this, the build own operate as well as manufacturing and the EPC projects within the group, we do feel that the impact will not be seen majorly. And also, we are now trying to focus for next financial year, actually some portion of our production goes to the export, which we are hoping for some, Africa and the Middle East. These are the two markets we are aggressively exploring, and that would take care of the prices are better than India prices. So that would take care of our the bottom line.
Understood. Another question is with regards to the lineage power. We have 93% and there were some plans to make it 100% subsidy. Any steps taken to complete this by March or first quarter of next year? So that the structure becomes clear.
Yes. So, yes, you are right that lineage power is 93% subsidiary. So we are in the process. We are estimating that this would be taken care in the next financial year. Because this financial year we are trying to set up the SPVs at 100%, wherever it is not 100%, we are trying to make it 100%, except for lineage power. So lineage power will take it subsequently. So there is a company called PREPL, Pace Renewable Energy Private Limited, which is taking up one of the which is a SPV for one of the projects, which is having 93%. So there we are at the final stages to convert it to 100%. So that process will be completed by end of March, post which will take up for lineage power.
Okay. Last question is with regards to the leakage that is happening between your standalone financial and the consolidated financial, and I assume this is because of the profit that you are earning on your own BO projects, which is getting eliminated in the consolidation. Now this problem will multifold as and when your BO capacity gets significantly higher. So what are the thought process? Are you thinking of creating two parallel companies and then demerge them so that you don't have to eliminate the profit in the consolidation out there?
So point number one, you are right. Yes, it is because of the eliminations on the intercompany sales that we have done from PACEDIGITK to the SPV. for the build own operate model of project, which is eliminated in the standalone numbers. The standalone revenues that we have stated is eliminating this intercompany sales. Yes, that's the reason. Point number 2, what we are trying to do in terms of leveraging this is that we are trying to find in terms of structuring these projects in such a way that after the accounting it can be shown as a sales and it can be leased back to us. So we are working on this particular model, but it is at the very early stages. Maybe soon we will be able to comment on this particular portion. Third, maybe as we updated to you, we are trying to have this Digitek Energy Private Limited as a whole scope for all these built-own operate model, which would be owning all the SPVs now. And at later point of time, if there's a good valuation, we have a plan to hive it off. So those in those angles we are working on, and we are trying to leverage it to a better valuation and selling it at a future date after the commissioning.
Thank you. I will get back into the queue.
Yes.
Thank you. We have the next question from the line of Amol Kankaria from Stratus Technologies Private Limited. Please go ahead.
Hello. Congratulations sir on a good set of numbers. Hello.
Thank you.
Yes, sir.
I have a question regarding this BESS project that we are on the BOO model. So what are the financing options that we have taken up for this project? And what is the cost of borrowing that we have for this?
So as I explained, right now we have 3 BOO projects with us. This is for about 3,250 crores of capex. This is already funded in terms of the equity from the IPO funds and plus the internal accrual. And balance 70 to 75% would be financed in form of the debt from the financial institutions. So we have already finalized for MSEDCL project. This is our first project where we have already secured the loan from ADA. And the next 2 projects, we are in the final stages with the financial institutions to close the financial requirements. The cost of borrowing we see at about 9% plus or minus 0.2%.
And what is the IRR that we are earning on these projects?
So with this interest rate, we are earning a IRR of about 14%.
Okay.
Equity IRR.
Around
equity IRR.
The equity IRR. Okay. Not the ROS. Not the ROS.
Not the project. It's equity IRR.
So what is the project ROS in this BESS project? What is the project ROS?
The project IRR will be anywhere between say 10 to 11.5%.
So it's a very thin margin. So as the interest rates go down, only then probably this would be more profitable, or the IRR can increase later.
No, normally we calculate on the equity IRR because the debt portion is reduced on a monthly basis in terms of the interest and the principal that we pay back. So we normally calculate for all the solar projects also, the calculation is done on the equity IRR, and the equity IRR for the solar is in some cases about 12 to 12.5%, but we are better in that sense. Normally it is always the equity IRR which is being monitored.
Okay. But then there is the O&M cost also, later on in the project life.
That has been taken care on the on the financials already.
Okay.
So from the income, we remove those, the interest burden and the loan and the repayment. Everything is taken care, and then we calculate the equity IRR. Rajavan,
yes, correct.
Okay. Okay. Thank you.
Thank you.
Thank you. We have the next question from the line of Chintan Mehta from Punishka Family Office. Please go ahead.
Thanks for the opportunity, sir. I just wanted to understand the ROI metrics of these industries in the container manufacturing. So how much capital we are going to put it and how much turnover we will get, and the asset turnover which we are in the normal bees and the container bees.
So you are talking about the container fabrication, or you are talking about the BESS side?
If you can explain the both ROIC metrics, that would be great. The asset turnover and the margins.
See, the battery energy storage system as a product has a margin of about 13 to 15%. What we do in our factory is that we convert the lithium-ion cells to a pack, lithium-ion pack, then to racks and racks to containers. That's what the value addition that we do in our factory. So we have a factory setup of 2.5 gigawatt hour up and running, which is going up to 5 gigawatt hour by March. So we have operational efficiencies in place, which will give us a better margin. So we are estimating that this margin of 13% will go up to 15% based on the operational efficiency. And with the container fabrication coming in place, which is a backward integration again, the margins are expected to improve another 1%. So that is what is expected.
And so asset turnover on both of that. So for example, we are putting close to 400-500 crore, and we are getting asset of close to 2,800 to 3,200 crore of revenue, correct?
Yeah. Yes.
So it's asset turnover will take time.
So asset turnover, if you want me to talk in terms of the margins which is built from this product, which is the asset capex which is put in, the payback comes in a period of 1.5 years to 2 years.
Understood, sir. And sir, the second question is on the BESS project which we put it and talking about 13-14% equity ex-IRR. Apart from this ex-IRR, we are going to make some product margin as well, correct?
You are right, yes. As we explained, it's a backward integration of business where we have EPC margins plus the product margins as well. Because Lineage Power is a manufacturing company who would be manufacturing the products for the project. Yes, that product margin will be in addition to the IRR that we stated.
So we do 100% everything in-house or 50% of the component in-house and multiply by the product margin, correct? Or how much percentage
around
we do in-house?
60%. Around 60% of the project will be produced in our factory. The balance goes towards the services and the third-party items like we call it as the BOS, balance of system, which is in turn with some transformers, HT panels, and the cables and things like that, which we are not manufacturing. So around 60% would be the product in any project of this nature that we are going to produce in our factory.
Okay, so then our overall IRR return will be much higher.
Yes. If you net off this, yes, it will be much better. Like there are two ways of looking at it. This margin is netted off from the project cost, so IRR will be far better, probably 19-20%. Or take this as the internal profit for the other two organizations, which unfortunately we are not able to show on the balance sheet because of that those SPVs are owned by us. But right way of looking at it is that the project cost will come down by netting of the internal profit, internal margin, so that the IRR is far better.
Okay. And sir, if you can explain this, the SPV is owned by promoter, or how this structure is?
Yeah. Let me explain, sir. I think in the interest of all our investors, we would like to explain this little more in detail. Like, just to give you the idea, like PACEDIGITK Limited is a listed entity, and then it has got a subsidiary of Lineage Power, which is about 80%. And these asset-owned businesses like build, own, operate, we have 3 projects and PPAs have been signed. These SPVs were under PDL, that PACEDIGITK Limited, as 100% owned. Now what we are doing is, since this business is becoming, we are increasing this portfolio, we have formed a new entity called Greenex Energy Private Limited, which is a wholly owned subsidiary of PACEDIGITK, and moving all these assets under that. So, and then grow that business to and by 2030, we have some good plans to grow that business into an annuity business, we call it as. What it means is that these projects are either 12 years or 25 years. There are two categories. One is the standalone BESS business we call, where only battery systems we deploy and we collect money on a monthly basis for 12 years. That is one model. The second model is that it is called solar plus BESS. So solar plus BESS is mandated now. So there the PPAs are 25 years. What we are trying to do is that by using this trans green energy, which we call the TGX as a short term, the TGX will own all these assets under SPV, and we will be growing this business independently. As of now, it is 100% owned by the PACEDIGITK, that is a listed company. In future, for equity, for all these three projects, we have already secured equity through IPO and internal accrual. But for the future projects, we are already working on raising money at a platform level, that is at a TGX level rather than a SPV level, so that we are going to have a leverage on the funds that we utilize. So the excess funds can use for new projects and things like that. So keeping that in mind, TGX has been formed. We are in the process of moving the assets under this platform, and future businesses of asset owned will be under this platform. And right now it is 100% owned by PACEDIGITK. And the later date, when we need money for the equity portion, we will be hiving off some portion based on the business needs.
Understand, sir. Thank you so much, sir, for explaining that. Just a last question from my side. Is it possible after a 1 point time we need to demerge this entity into separate company so that our debt and equity cost of fund will be quite very lesser?
Absolutely. We will be doing that at an appropriate time where we create some value in this platform, and there are some good positive vibes coming up from the market on this, because in solar also, if you have seen, these kind of platforms are very famous, and we are working in that direction. At some point of time, yes, the demerger also is possible to get the full benefits on this business. But as I mentioned, we are in the process of creating this. We have already done this, and then we are executing all these projects under this platform. So there will be PACEDIGITK, Lineage Power, and Trans Green Energy. These are the two subsidiaries of PACEDIGITK, and we will try to take appropriate decisions in the interest of the company, sir.
Understand, sir. Sir, just the last one more, if I can. Just wanted to import part of the BESS. How much import is cheaper compared to our, or it's neck to neck from the Chinese or a Korean batteries? Even at container level, or this only at BESS level? Just any blended you have, any number that 20% cheaper or something kind of?
Yeah. So there are, okay, this is also very interesting question, sir. Again, in the interest of all our investors, we would like to elaborate a little more. Now, for us, the input is the cell. We buy the cell alone. Naturally, the scale is built in China, so we are buying from 4 such partners who supply us the cells, and these are all top-rated companies in China, so we buy from them. Now, the import duty is 5% on the battery cells that we procure, and we convert into container and then supply as a product. Now, if some people have to buy these containers from China, there are 2 aspects. One, the cost of the container plus the import duty. Import duty, as per the policy, is 20%, but most of the people who are trying to bring it at 10% plus sales, that is at 11%, tries to bring that as SKD level, that is semi-knockdown condition. Or sometimes packs, they bring it at 11% and want to do it here as a container. So for example, if the cell cost is, let's say, $40, we pay import duty at 5%, let's say, that's about, the 5% of $40 is about, let's say $2 we pay as a duty. Whereas the finished container today is about $72 from China. On that, let's say 10% they do is $7.2. So the duty difference itself is $5. That is the first point I would like to, I'd like you to note. So there is a difference in duty itself from a cell to the finished product. So that is significant. That's almost, $5 and $70 is very, that could go into our profit, number one. Number two is that we are comparable for the $72 when we manufacture in India. We are competing with Chinese on a like-to-like basis. The other indirect benefits for our customers that we are offering is that The local manufacturing will have local support, spare parts, and these are long-term projects. Whereas if they import from China, they only get a product, but then there is no support available in India. And in a long-term project like this, something goes wrong. It is like a binary. Battery system is working or not working. If it is not working, and if the 95% is the availability minimum expected in the contract, if that is not taken care, then a lot of penalties will kick in. So there is always a mixed reaction as of now in the market that should we import from China or should we look at local. So there is, we are working with our customers, so people are inclined to buy from us. So there are good positive developments working on where they are visiting our plant and they are trying to give, and some people have already given orders to us, like L&T has given order to us, which we are executing in this Q4. Then Advait Infra has given another order. There are some more orders that are expected soon. So now I can confidently say that we are comparable with China prices on apple-to-apple basis. The duty benefits are helping us. Number 3, the local support and spare parts, all that also indirect benefits that China doesn't have. And this product is being technical. It cannot be just that, we install and no need for any services. So these are the 3 indirect benefits and the 2 direct benefits by which we are confident that we can do well to supply to our other customers as well.
Understand, sir. Understand. Completely. Thank you so much, sir, for answering such a brief and detailed. That was a lot more helpful. Just suggestion from my side, if we can do more road shows or a plant visit to the analyst, that would be great for everyone. Thank you so much, sir. All the best.
Yeah, sure. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address all the questions from the participants, we request you to kindly limit your questions to 2 per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Dipesh Sancheti from Manya Finance. Please go ahead.
Hi, am I audible?
Yes. Yes.
Okay. The gross margin declined, whereas also the EBITDA margin Y-on-Y declined, as well as, Q-on-Q it was almost, flat. What is the trajectory which the management is looking at? What is the margin going forward? And we should expect volatility as the execution scales up?
Yes. So as we explained, the telecom has a better margin in terms of one specific project that we have undertaken for the tower erection, which has enabled us good margins for this year and also in the past. So for this financial year specifically, there is a mix of both the telecom and energy, so which has impacted the EBITDA margin. As we explained, going forward, it would be the energy order book which is going to have a significant contribution to the overall top line. The EBITDA margin, yes, there is a dip between the last year-on-year Q3 for this particular reason, and we expect to get stabilized at this level, what we have shown in Q3.
Okay. And the order book of 8,268 crores, how much till when it will be realized, and what is the percentage of realization in Q4?
So as we explained, except for the build-to-own-operate model, which is about 3,250 crores of order book, this will get executed, but the revenue will flow over a period of next 12 years' time. But for the balance, which is about 6,300 crores, that will add to the overall top line of the business between this Q4 next financial year and H1 of the subsequent financial year.
So in Q4 FY26 as well as Q4 FY27, that is what you said, right?
27 plus the H1 of FY28.
FY28. So till then we'll be able to finish all the orders.
Yes.
Okay. Right. And what about the finance cost, which has reduced significantly? How much of it is structural versus timing related?
The finance cost is reduced because of the reason that yes, this year we had a lower borrowing compared to the last financial year. And moreover, as we explained, the build-to-own-operate model has just kick-started, and we have got the first lot of funding for this. This finance cost is expected to again come to the normal levels with the term loans coming in place for the build-to-operate model.
Okay. What will be the CapEx going forward? If you can give a guidance till around FY 2028.
As we explained, the CapEx expansion from 2.5 to another 2.5 is already in process, and we are expecting in next 2 months time it will get commissioned. The next financial year, we are doubling this capacity from 5 to 10. This will again have a capital outlay of about 80 to 100 crore rupees because we have all other infrastructure in place, and plus the land which is available with us. Only the plant and machinery and the structures we need to put, which is for about 80 to 100 crore rupees, which we would be investing in the next financial year. Plus the container fabrication, which we have already undertaken as a capex outlay of 30 to 40 crore rupees, excluding the land again. Land is already owned by us. These are the immediate capex for the next financial year. Subsequently, we are yet to plan for FY 28 and 29. Yes, we have some plans. We would be announcing it at the appropriate time.
The entire CapEx will be funded by internal accruals only?
Yes, right. The accruals that we have taken in the telecom project will be used for all these CapEx.
Right. Thank you so much.
Thank you.
Thank you. We have the next question from the line of Bhavna Jain from Avagra Capital Advisors. Please go ahead.
Hello.
Yeah. Yes. Hello. Good morning.
Thanks for the opportunity. Yeah, good morning. I just have a question on the BESS business. The order book has 54% BOO projects and 41% as EPC projects. Am I right? First question is the margins you have already given. Just that the BOO projects are meaningfully higher in case of IRR, does that mean slower cash flow as compared to EPC?
No, it's like this. Yes, you are right. About 38% is from the developer projects out of the total order book, which will include, when I say developer project, it is including the EPC and the product. On the IRR side, yes, it is 14%. As we explained, it is excluding the product margin and the EPC margin, which is the break in the legal entities of PACEDIGITK and Alfa.
Okay. The question is about the cash flow itself. It's similar or it's different again?
It is different for the reason that when it is the EPC contract, it is the working capital which needs to be put, which will remain with us for the commissioning period plus 6 months time. But for a developer project, the term loan which is taken will be repaid over a period of the project tenure, which is about 10 years for a 12-year project.
Okay. Can you give a little blended EBITDA margin only for the energy order book, if there is anything? I mean, maybe FY 27?
Yes. As we explained, the product that we are supplying from our factory, which is the BESS product, has an EBITDA margin of about 13 to 15%. When I do this product, when I use this product for the EPC project, the EPC will have an additional margin of about 8 to 10%.
Okay. Additional?
Yes, additional.
Okay. This last question on the working capital side. How is the working capital position in case of this BESS business or the energy side business? If you can just give a highlight, because the blended working capital looks a little, because as we know that the telecom side is a little more higher as far as the working capital is considered. Can you just give a little difference of working capital between these two businesses, the BESS and the telecom? It is the BESS one.
Sure. The telecom remains at about 120 to 150 days of net working capital. Yes, it is stretched because of the retention monies that is inherent nature of the tenders that we have. For the BESS project specifically, we again, for the EPC, for the project specifically, the working capital we see is about 90 days. For the EPCs, we see about 90 to 120 days.
Okay. Now, just a question or a follow-up question on the previous participant when you were discussing about the TransGreenX thing.
Yeah.
Is my understanding correct that the TransGreenX company will have all the businesses which are product or manufacturing side? That will include the telecom as well, or it will include only the manufacturing portion of part of the BESS business?
Yeah, let me explain again. So the Greenex Energy will be a wholly owned subsidiary of Digitek, which will be holding all the developer projects. The build-to-own operate model of projects will be put under this holdco level in a separate SPV. So this company will be holding only the build-to-own operate model of business, which is the annuity model.
Okay.
While the manufacturing and the EPCs are kept separately. This company is only for the build-to-own operate model of business.
Okay. Just one last question from my end about the business again. So what will be the revenue potential? I'm trying to understand the unit economics of this BESS business. But what will be the revenue potential of each 1 gigawatt hour of this capacity support? I mean, if there is any base number to be given.
So I would state in terms of per megawatt hour, so it is about 1.2 crores to 1.3 crores per megawatt hour at the project level, EPC level, which will have about 70 lakhs of the product, in-house products that we have. So this is including the taxes.
Okay. No worries. Thank you so much for all the answers. Thank you.
Thank you.
Thank you. A reminder to all, request you to kindly restrict yourself to one question per participant. If you have a follow-up question, please rejoin the queue again. We have the next question from the line of Ravindra Nayak from Sunidhi Securities. Please go ahead.
Thank you for the opportunity. So you mentioned that you will be getting another 4,000 crores of base orders in the next in this quarter by the end of this year. So what would be the BO component and what is the EPC and supply component in that 4,000 crores additional orders you are expecting?
So this will be this will be having a mix of both BOO and EPC for about 60:40.
Okay, 60:40.
Yeah, right.
Okay, so that means we will be finishing this year with a BO order of up to around 5,000 crores or more than that. Is it right understanding?
Yes, sir. We are estimating this number. Yes, right.
Thank you. We have the next question from the line of Aditya Sharma from Polani Capital Advisors LLP. Please go ahead. Aditya, please proceed with your question. Due to no response, we will take the next participant. We have the next question from the line of Saurabh Khara from VT Capital. Please go ahead.
So what is the base industry size in terms of volume and value? Can you repeat?
Sir, your question is not clear. Can you repeat?
Hello. So what is the base industry size, domestic industry size in terms of value and volume?
You are trying to ask for the local content, the domestic content of the material?
Yeah. What is the industry size?
What is the industry size of this?
Okay.
Yes, sir.
Okay. So by 2030, the government document says it is 236 gigawatt hour is required for the country. Based on this renewable energy integration of 500 gigawatt, the estimation is that best requirement is 236 gigawatt hour by 2030. That is the demand.
So what is the current size?
Sorry?
What will be the current industry size? By 2030, it will be 236 gigawatt per hour. What will be the current size?
Yeah. So out of this 236 gigawatt hour, the country has already, with all becomes put together, they have issued the tenders of about 40 gigawatt hours, out of which about 25 plus gigawatt hour is already awarded.
Okay. 20 gigawatt already awarded.
Yes. and out of which we are proud to say that we have 3 gigawatt hours of developer projects plus the 1 gigawatt hour of EPC project.
Thank you. A reminder to all the participants, kindly restrict yourself to one question per participant. We have the next question from the line of Tej from Nirishan. Please go ahead.
Hello, sir. Am I audible?
Yes.
Thank you so much for the opportunity. You very well explained the import versus domestic price point to the earlier question. Just wanted to get your viewpoint on, a lot of players today, what we understand are, putting up capacity from cell to pack or maybe cell to rack or container in India. So, in that case, how would we compete? What will be our pricing strategy? And it will help me understand, what will be the current installed production capacity of from cell to pack in India, and what we understand, a lot of lines are coming up in India, right? In that case, how will the competitive scenario look for us?
Yeah. Today, we are the largest BESS manufacturer from cell to container. That is proven and it is in the market already. Yes, many people are thinking of doing it, but in my opinion, this will take about 1.5 years, at least 1 year and above, to basically get some capacity built in India. We do want more capacity being built because there's a lot of demand coming up. At the same time, from our own company point of view, we would like to maintain the lead that we have taken, that being the front runner. We want to maintain this lead even going forward. That is where we are adding another 5 gigawatts. So we would like to be a 10 gigawatt company, hopefully by September of this year. So with that, the capacity will certainly be ahead of the curve. And then we take the decisions appropriately. Like as we mentioned that we have already started the further backward integration of container manufacturing, which others are not even doing that today. So we will keep taking these kind of decisions at an appropriate time to maintain this lead. The demand looks very good. So there is a scope for many such companies to get into. However, we would like to maintain this lead, for some more time.
Got it. So if you could help me understand, what will the current installed production capacity from cell to pack in India? Any idea on that?
That's other than us, there's no production capacity from cell to pack or cell to container as of now. Some people are doing pack to container because the cell to pack is the critical thing. So people are bringing the packs and then doing it as of now. But cell to container, I would say strongly that we are the people currently having this capacity. But there will be something coming up, we don't want to name them, and the next 8 to 12 months, 1 or 2 companies are going to be ready.
Thank you. We have the next question from the line of Gata Jain from Anantnath Skycon Private Limited. Please go ahead.
Hello. Thank you so much for the opportunity and congratulations on good set of numbers. I just wanted to
Sorry to interrupt. Gata, you're not audible. Can you please use the handset mode?
Hello, am I audible now?
Yes, please proceed.
Alright. So I just wanted to understand going forward as the competition increases, do you see a possibility of the margin shrinking down?
Yes, the margins are a factor of the raw material prices and other aspects. With the competition getting built on, what the advantage that we have is that we have a early mover advantage, where those are people who are coming in the next 1 or 2 years time. By the time we would have stabilized our product and stabilized our efficiency factors. So we don't expect margin dip in a bigger way because margins are already linked for this particular sector of business. So we don't see a bigger thing further to this.
Alright. So going forward, what margin do you expect? Like the stabilized margin?
So as we explained, the product margins are expected, the EBITDA margins are expected at about 13 to 15%. The project margins are expected to be about 8 to 10%.
All right. Thank you so much.
Thank you.
Thank you very much. Ladies and gentlemen, that was the last question for today. And with that concludes the question and answer session. I now hand the conference back to management for the closing comments. Thank you, and over to you, sir.
Yeah. So, on behalf of PACE family, we thank everyone for attending this call, and we thank all our investors who have interested us and they have invested in our company. And the company, as you hear the numbers, it is going to the next level in terms of the energy transition. So, with this, we thank all the investors who have participated today. Thank you.
Thank you, management members. On behalf of Golden Advisors LLP, that concludes this conference. Thank you for joining with us today, and you may now disconnect your lines.